Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo, and on today's episode, we're going to be talking about retirement planning, specifically what you should be doing today to help yourself be successful to actually retire, whatever that may look like for you. Even if you are 20, 30 years away from retirement, I want you to really listen to this episode because the fact of the matter is we're making decisions today that will affect how our lifestyle, specifically our cash flow, the money from our assets, will look like in retirement. So without further ado, let's dive right in for today's episode. So the first thing I want to bring up is, what are we saving for? Right? We're saving hopefully to turn on an income stream later on so that we no longer have to work. And so when we take that into consideration, we have to look at what are the factors involved with that. And so what I mean by that is this. Every time I ask a client or prospective client, what is it they care about in retirement? It's really these 5 things. They want the highest cash flow or highest income that they can possibly get from their assets in retirement. They want to pay the lowest rate of tax on that money that comes to them. They never want to outlive or outrun their money. They want to meet any legacy objectives, right? And maybe they don't have legacy objectives because maybe they don't have kids, but they want to make sure that they don't disinherit their spouse, meaning exhaust all of their assets and their spouse isn't left with much if they were to prematurely pass away. And then the 5th one is to be able to do all 4 of those that I just listed with minimal dependence on the market. So what does that look like? Well, let's take a look here. So as we look at the balance sheet here, you can see this client, right? They've got a good amount of money sitting in retirement. They've got these savings and investments. What is their plan? Well, what do most retirees do? So let's take a peek and look at that. So if you've got a bunch of money sitting in your assets, right? And most of the time we have that money sitting in stocks and bonds, right? Like most people, when they get to retirement, the vast majority of their wealth is sitting in a 401k type of plan, like a retirement plan. So if you're sitting on $4 million of assets when you get to retirement, how much money can you distribute from that nest egg and not outlive your money? So let's take a look and see how this plays out. So what you're looking at here is what's called a Monte Carlo simulation. And in this Monte Carlo simulation, it's going to spit out a failure rate. What percentage of the time will this person outlive their money based on the variables that we put in? Let me pause real quick. I should have started this episode with this. If you are listening in your car, I definitely suggest you hop on YouTube later on or go to our website with the video, because this is going to be very visually dependent for today's episode. I'll try to speak into it as much as I can so you get the gist. So back to the retirement here. We've got $4 million of assets, right? Where is that asset sitting? Like, how aggressive do most people get when they're getting close to retirement? Are they still aggressive with their money, meaning having more stocks than bonds? Or are they more preservation? Maybe they have more bonds than stocks, or somewhere in between. So what I'm going to do for today is I'm going to just choose a conservative portfolio. This conservative portfolio in general gets an average rate of return of 8%. So you got $4 million. You're going to get an average rate of return of, call it 8%. Now keep in mind, that's average. Some years you get higher, some years you get lower, some years you get negative. And that's what this calculator is going to do. It's going to do 1,000 different iterations and say, okay, what's the chances that this person outlives their money? So in $4 million, living on 8%, right? If they want to do the interest-only type of an approach, that's $320,000 per year. 4 million times 8% is $320,000. Okay? Now, does this person also want to keep pace with inflation? Obviously, the answer to that question is yes. I'm going to use a 3% inflation rate just for simplicity's sake for today's conversation. So $4 million, taking out $320,000 a year because they're supposedly getting 8% in their portfolio. And I'm going to put a 30-year study period. So we're going to do ultra traditional. This is a 65-year-old, taking them all the way out to age 95. and they're going to take 3% inflation on that money, meaning 320 is year one. They're going to take 3% more the next year, and then 3% more the next year. So that 320 is the baseline. That's where we're starting. As we calculate here, it's going to spit out a failure rate. And as this thing is calculating, you can see it doesn't look pretty. 95% of the time, this person is going to outlive their money. You can see all the different iterations that occurs. We have this person that ran out of money in like year 11. And then we've got this person that actually didn't outlive their money. They're still worth $866,000. Well, what's occurring here? Well, what's occurring is $320,000, when we take into consideration inflation at 3%, let's just take a look. 10 years in, that 320 is now 430. So 10 years in retirement, they're taking out $430,000 a year. 15 years in, they're taking almost $500,000 out a year. So they're taking more than the portfolio is getting in rate of return. That's why they outlive their money. So there's a rule of thumb out there. The rule of thumb is you can take 4% of your nest egg with a low risk of outliving your money. By the way, this is just a rule of thumb. I'm not sure anyone really follows the 4%, like exactly 4%. But I think a lot of retirees, at least the ones that I'm speaking to, they're taking some interest-only approach. And it's not the 8%. It's like 4, 3, maybe 5% on the high end of stuff. And you can see why. They don't want to outlive their money. Right? And it's not just their lives, it's their spouse's lives. So 2 lives have to live on this money. They don't know what's going to happen in life. They're concerned about medical costs. Right? But we want the highest income. We want to pay the lowest taxes, but we don't want to outlive the money. So this is what a lot of people do. Okay, so they do this interest rate approach. Can we do better than this? Yes, we can, and we have to build in different strategies around how to financially plan. And so those decisions you're making today, where we're putting our money, what are the taxation of the money? How much of your money should be in the market? How do you turn on an income stream? Not that you have to have the plan. Like if you're 30 years old, you don't have to have the plan today to figure out how much income and what that's going to look like. It's more around having asset allocation, meaning having our money in different buckets, not putting all of our money in the stock market, actually building a bucket, what we call the backstop to everything, building a bucket of money that's just kind of steady Eddie in the background, that builds over time, that gives us flexibility when we get to retirement. And then what are the strategies that we can employ to take out money from the retirement? Okay, so now that I've set the stage here for retirement planning, the next conversation that I'm going to set up in our next episode, I'm going to dive into how do we set up the balance sheet? Meaning, what are the cash flow strategies we can employ where we don't outlive our money, we can minimize taxes, right? And we can have legacy put in place. And that's what we're going to go over in the next episode. So this is just part 1. In the next episode, we're going to go through those other 3. We're going to go at a high level. I've done this episode a couple times, but I wanted to readdress that today. If you got any questions, head over to beerandmoney.net. At the top of the page, hit contact us. And that's a great way to ask any questions around anything that's coming out from today's episode. Hope this episode was valuable for you. Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7778850.1. Expiration date March 2027.